Hello, everyone, and welcome to Elliott Davis's Navigating COVID-19's Impact on Manufacturing and Distribution. I'm Bill Woodward, a shareholder with Elliott Davis in our Augusta, Georgia office. And on behalf of all of us here at Elliott Davis, we hope you are safe and secure during this crisis. No matter where you are sheltered or social distancing, our thoughts and prayers are with you. We know that many of you are facing very difficult business and personal challenges. And like you, we are looking forward to being on the other side of this. And it's with that spirit that we want to provide you with some meaningful information to help you, your team, and your business navigate this difficult season. Like us, you have a lot on your mind, a lot of questions, a lot of uncertainty. In this conversation, our focus will be tax. However, we will have future conversations tackling other topics. Today, we have two of our firm's experts that serve our manufacturing and distribution customers queued up. Rebecca Leshman is a tax-focused senior manager out of our Greenville office. Hey, Rebecca.
Hi, Bill. How are you?
Good, thank you.
Good.
And JJ Littrell, a director out of our Charlotte office. Hi, JJ.
Hey, Bill. Thanks for having me.
Great. Glad you're here. Both Rebecca and JJ serve manufacturing and distribution customers throughout our firm, and if they've been fielding a ton of questions and concerns. So Rebecca and JJ, I thought we would run through some of those questions and concerns that we've been receiving from our customers. How does that sound?
Sounds like a plan to me.
Yeah, thanks, Bill.
Great. So cash is always king, but in this current environment, cash and keeping all the cash that you can to, maintaining a strong balance sheet, maintaining liquidity, is very important right now. What are some of the stimulus provisions that allow for companies to conserve cash?
Bill, I think that's a great question. A very common question that we're getting right now is, what can I do to hang on to my existing cash? And for me, the sort of most obvious answer is tax driven, and that's, well, you normally have an April 15th tax payment date for both, if you're a calendar year taxpayer, your 2019 extension payment or tax return payment, and then also a potential first quarter 2020 tax payment. And what the stimulus packages have done thus far is actually deferred that April 15th payment to July 15th. So you actually have an additional 3 months to hold on to your cash a little bit longer than you otherwise would have. What that also does is, and I'm sure we're going to talk about this a little bit, is it allows you to reassess what your 2019 and potentially your 2020 taxes might be, because there have been a variable number of mechanisms that the CARES Act specifically has enacted that actually could impact your taxes for 2019 and 2020. So while you do get that 3-month deferral, what you also get is an additional amount of time to review your tax profile and understand and digest what those provisions will mean for you as a taxpayer. In terms of conserving cash, there's also a few payroll tax credits that I believe really allow you to sort of keep your existing cash in hand versus, potentially distributing it to the government. But I think before we maybe get into a conversation about those credits, maybe it makes sense to sort of understand how they come about. What payroll provisions do you have to be subject to as a company in order to trigger these benefits? And I think JJ's probably better suited to talk about that than I am. So JJ, I'm going to defer to you at this point.
Yeah, absolutely. So I think in general, we could all agree that many of the stimulus acts all of the provisions of the acts are really trying to help keep people paid, keep people employed, and support businesses in their in paying their payroll. So when we look at our different options when it comes to how we can be supported as business owners, two big things to consider. The first, and this is from a payroll perspective, the first is the Families First Coronavirus Relief Act. This is for businesses that are under 500 employees. That can be determined in a number of ways based on affiliate rules and things like that. So I won't get into that here, but that is something to consider. Things you never think about before things like this come up is, what qualifies as a business that's over 500 employees. So we can certainly talk about that offline with you if you have any questions of whether or not you qualify. But for those businesses that are under 500 employees and have people who are still working, you are able to get a credit back related to any payments that you make for the sick leave provisions and the extended FMLA provisions of the Families First Act. So there are different reasons why your employees would qualify for these acts, and there are stipulations of what you are expected to pay them at a minimum. You are able to extend your sick leave policies and your vacation policies and your FMLA pay beyond what the act requires, but the act does stipulate what you can get credits for back. So very important that your employees understand what qualifies for that, and that you as an employer understand what qualifies, and then also making sure that you're retaining information and documentation to ensure you get those credits. Talking right now about how do you keep cash in hand, the great news about the Families First credits and all the payroll credits is that they are allowing you to, rather than make the deposit and remit the taxes that you owe and then wait for a credit back, you are able to reduce the amount that you remit by the anticipated credit. So again, very important those calculations are done correctly, and in conjunction with all of these other things that are going on, that they all play well and intermingle together. But you are able to reduce your remittance to keep that cash again in hand. And then also, if you expect that any of these payroll credits will exceed the amount of your payroll tax liability, you are able to file for they call it emergency credit, where they will give you a refund to the extent that those credits exceed your liability. And that is for Families First, as well as something else that we're going to talk about in the CARES Act. So number one, that impacts a lot of businesses for Families First. And then from a CARES perspective, there are 2 payroll tax opportunities to keep cash in your business now. One of those is the deferral of your payroll taxes, of not having to remit your employer portion of Social Security tax, so 6.2%, being able to defer paying any liability that you have from now on in 2020 through the end of 2020, deferring 50% to be paid December of 2021, and then the other 50% December of 2022. There are not currently any stipulations around economic impact from COVID-19 or size of business. So this should be something that all businesses can take advantage of. We're kind of looking at it like an interest-free loan, where you're able to take that money, defer it, use that cash in your business right now for other operating things, and then make those payments in those out years. So that's an excellent opportunity to keep cash in your business now. Yeah. And then the last credit is the employee retention credit, which is related to, again, a payroll credit that you can take from your payroll tax liability, related to businesses that have suffered losses greater than 50% when you look at gross receipts year over year in the same quarter, or businesses that are shut down completely from COVID-19 related statutes or business slowdowns, things like that. There is a different way to calculate the number of employees for that credit. There is 100 employee differentiation there between how you treat this credit and what you're eligible for. So a lot of meaty information there, and the credit is, again, a calculation that is complex, but is an opportunity, again, to keep cash in your business and potentially be paid back for payroll that you are paying for employees that are not able to work, but that you want to keep employed and that you're going to keep on your payroll.
JJ, that's so impactful. You mentioned calculations several times in there. Are those calculations complex?
Great question, Bill. I think, on the surface, it looks like just a couple of words, and it looks like something that you could just do quick math on, but truly the interplay of these credits with each other, as well as understanding what your business specifically qualifies for or does not, and also making sure that you take the most advantageous position out of all of these credits. It can be very, very complex. And it's also really important because this is all happening so quickly. Things are changing very quickly. Designations are changing quickly. We're getting a lot of information on a daily basis of what's considered applicable or not and how they're defining things. It's changing very, very quickly. So really, really important that you're working with someone on these credits that is deeply knowledgeable about what has been allowed for or not, and making sure that all of those things are playing together for the most advantageous credits for your business.
JJ, I understand that there's maybe some added complexity if you have applied for or are granted one of the SBA loans. Maybe you speculate or talk to some of that complexity.
Absolutely. So the idea is that you are not going to be reimbursed more than one time for a payroll dollar. So, for example, if you've applied for and potentially received a PPP loan, and that's going to potentially be giving you a credit back for payroll expenses that you're paying, you can't also on that same payroll dollar get the employee retention credit or any of the Families First credits. But those things can play together in different time periods. So this is something that, we hope, we all hope that this is over more quickly than not. But to the extent that this does go beyond the next couple of weeks, there are interplays of time periods where you can take advantage of different things and different programs, different times, with the main concept being that you only get reimbursed for a single payroll dollar one time under any of these credits.
Thank you.
Mm-hmm.
Rebecca, what about companies that maybe were profitable in the past, paid taxes in, not anticipating being profitable or having taxable income this year? What are the provisions that apply to them?
So I think we've talked a good bit about how to conserve existing cash, but what we're now helping companies do is look to taxes that they've historically paid and considering some of these various income tax provisions within the CARES Act to see if we can help companies monetize or recoup those historically paid taxes. The CARES Act actually has a number of provisions in it that do enable taxpayers to reclaim those taxes and to find, new sources of cash flow by getting refunds of those taxes. So maybe, Bill, I'd like to spend a little time talking in specific about some of those provisions. Probably one of the larger provisions that we're seeing from a talking point perspective and really an implementation perspective so far relates to the net operating rules and net operating loss rules, excuse me. And maybe starting with a little bit of history of the net operating loss rules and the evolution of those rules over time would probably be a good place to start. So before the Tax Cuts and Jobs Act, which was enacted in December of 2017, net operating losses had a finite carry forward period of generally 20 years and also had a 2-year carryback period. So if you were profitable in a year that predates your generating a net operating loss, you had an opportunity to carry that loss back to prior years. What the Tax Cuts and Jobs Act did is for any NOLs generated in a post-tax reform year, they repealed the ability for you to carry back those losses. At the same time, they did elongate the carry forward period to an indefinite amount, but you did lose on that ability to carry back those post-tax reform losses. And so one of the provisions that the CARES Act actually does is repeal that preclusion from carrybacks on post-tax reform NOLs. And in fact, what they've done is they've actually elongated the carryback period. So not only now do you have an opportunity to carry back NOLs 2 years, but they've actually added an additional 3 years such that you have a total look back period now of 5 years. Which would, if for 2018 NOL as an example, that have you looking back to taxes you've paid as far back as 2013. Certainly great news for a lot of our companies, and especially when you consider the fact that prior to tax reform, a lot of our corporation taxpayers were subject to a higher statutory tax rate of 34 or 35% now compared to the 21% statutory rate. But what we are seeing is that it's really worthy of a modeling exercise to understand what the effects of these NOL carrybacks are to you in your historical tax profile. What I mean by that is that there are a lot of deductions historically and currently that are based on taxable income. And so what you want to ensure is that you're carrying your NOLs back to a tax year where they are as valuable as possible, and where you're not encountering some sort of substitution effect where, yes, you're carrying a loss back, but now you're foregoing a deduction because you're reducing income. And so from my perspective, it's not necessarily a clean cut, yes, let's definitely carry back every loss we've got. It's really, let's model it to ensure we understand what those carryback benefits will be. And if they're not what we think they are, and if the cash isn't worth it, we don't need it that drastically, then let's elect to forego those carryback losses. So that's really maybe the first action item I'm seeing.
Can I ask a question real quick?
Of course.
You mentioned modeling. How difficult is that modeling to do?
It can be complicated. I mean, we're talking about a lot of different tax years. We're talking about two different tax regimes, sort of pre-tax reform and post-tax reform. And there's a lot of complicating interrelationships between some of these tax provisions. And so I would say it's probably more complicated than we would like. There's a lot of room for error. And what you don't want is to think you're getting a refund, and then when you actually get your refund back, the IRS to have taken some sort of haircut that drastically, reduces the benefits you thought you were going to claim.
Sure.
Now, Bill, in addition to the net operating loss rules, there's actually a couple of other provisions that the CARES Act also offers that allows an ability to maybe retroactively claim some tax refunds. One of those is an actual fix to the Tax Cuts and Jobs Act. Finally, much anticipated, we've been waiting this fix for the qualified improvement property, but what tax reform did back in 2017 was unintentionally preclude certain fixed asset additions that are considered qualified improvement property from being eligible to have accelerated bonus depreciation claimed on them. And so what the CARES Act finally does is implement a technical correction to now allow qualified improvement property to be subject to 100% accelerated write-off in the year that asset is placed in service. And you are actually allowed to go back all the way to the tax reform dates to reclaim any of that accelerated bonus. And what's interesting is I was talking about interrelatedness with the net operating loss calculations, is that you could be going back now and claiming bonus depreciation, which changes your net operating loss or tax situation. And so again, just reiterating, modeling is really key here in terms of understanding what all these benefits are and how they work together.
Sure.
Really the last CARES Act provision. Sorry, Bill, did you have a question?
No, I was just going to comment that maybe one silver lining with COVID-19 is that we actually fixed something in the tax code.
Yes, it took a few years, but finally a few years, and a lot of pressure from taxpayers to get it fixed, but finally we're there. Still awaiting some implementation guidance in some respects, but at least we know it's on the table. One of the last maybe refund opportunities that we're seeing has to do with corporate AMT. So another hallmark of the Tax Cuts and Jobs Act back in 2017 was repeal of corporate AMT. And so for taxpayers that may have been subject to it historically that had an associated AMT credit carry forward, the Tax Cuts and Jobs Act provided a pathway to reclaim or refund those AMT credits. What the CARES Act does is provide a mechanism to accelerate that refund process, so you can actually either request a full refund of your AMT credits on your 2019 tax return, or claim a carryback on your 2018 tax return. So quick access to those refunds. The last thing I'm seeing a lot of questions about, and that we're doing a lot of diligence on, is quick refund applications. So this isn't a specific provision that was created by the CARES Act, but maybe has found some newfound fame as a result of some of these provisions. What the quick refund does is allows you to request a refund from the IRS of any overpayment of your taxes prior to actually filing a tax return. And so for calendar year taxpayers that may have an extended deadline of July 15th now or October 15th, you can go ahead by April 15th and request a refund of your contemplated overpayment before that tax return is filed. Official guidance indicates that quick refund application is still due April 15th, so that is not something that received that July 15th deferral. So it's really critical that if this is a provision that you're looking to benefit from and get your cash back in hand sooner than later, that you make those requests, here within the next week.
Sure. Great. Thank you.
Absolutely.
So a lot of our customers and just companies in general, a lot of them are shut down, partially shut down, revenue declines, furloughing, laying off employees, a lot going on there. Now, we've talked about some of the tax provisions, but is there anything additionally that companies that are experiencing those slowdowns or shutdowns or furloughs or layoffs, anything else they should be considering?
Absolutely. So we touched on it a little bit with the employee retention credit. So if you are a business, and again, the stipulation here is 100 employees is kind of the demarcation line for how your business needs to be impacted in order to qualify for these credits. But basically, this allows you to get a potential credit of up to 50% of qualified wages, up to $10,000 per employee, which would be up to a $5,000 credit related to employees that are being paid and are remaining on your payroll but are not able to work. So if you're over 100 employees, if your location is shut down, work site is shut down, and you are continuing to pay, let's say, managers or things like that to keep them on payroll to be able to bring them back quickly when business returns, then you are able to potentially qualify for the employee retention credit. If you are under 100 employees, those employees over 100 employees cannot be working but still getting paid to get the credit. Under 100, the employees can be working. You just need to show that you have 50% decline in gross receipts from same time last year from a quarter perspective. So great opportunity there, again, to keep people paid, keep people engaged, but allow for a credit back, again, on your payroll taxes. From a furlough perspective, the expanded unemployment has done a lot here to make sure that even if folks are furloughed, not entirely laid off, but furloughed so that they can be brought back quickly, they are still eligible for unemployment. That has expanded considerably, as many folks have heard. The wonderful thing that we've seen in all of this really, really hard time is that our customers are worried about their employees. They want to make sure people are not missing paychecks. They want to make sure people are getting paid. And the expanded unemployment is an opportunity for businesses to look at that as one of the things on the table to help support their employees while their business is going through a really, really difficult time with all of the COVID-19 impact. So the expanded unemployment will allow for folks who are furloughed or laid off to apply with their state, just like they always would. Whatever the benefit is that the state calculates that's appropriate, they are paid that amount. And as long as they qualify in their state for unemployment, then the federal unemployment on top of that is an additional $600 a week. At the time of this recording, that $600 is not being pro rata any kind of change in pay, things like that. It's a binary yes or no. So to the extent that your employees could get that additional federal along with their state, it allows for, again, a bit of a stopgap before you're able to bring them back to work and put them back on payroll. So not something, sometimes unemployment has a bit of a stigma to it, but right now with these additional benefits, it should be something that you're considering as part of your plan to make sure that your folks are getting paid, but then also you have a plan that keeps cash in your business for long-term continuity.
Yeah, JJ, that's interesting. So I actually have gotten that question a few times from some of the companies that I work with is, they're contemplating or exploring or have already laid off or furloughed employees. And, that sentiment that they just really want to make sure that they've educated their employees as to what provisions are out there to help them during these hard times. And like you said, educating their employees about the unemployment benefits is a great way to do that. A couple of other individual tax provisions that the various stimulus packages has offered that may be good to communicate to furloughed or laid off employees. The stimulus payment certainly is a big talking point. The CARES Act will offer a recovery rebate of $1,200 per individual and an additional $500 per qualifying child for taxpayers with certain AGI thresholds. And those refunds, from all intents and purposes, as we understand them, they're intended to be refunded sooner than later. I think we've heard within 3 weeks. That was about a week ago. So hopefully hearing that those refund payments or stimulus payments will be coming very soon. The mechanism that the government intends to issue those stimulus payments is primarily through direct deposit. So we're expecting a portal to be set up on the IRS website to allow taxpayers to review their direct deposit information and ensure it's up to date. So that's certainly a great source of cash to laid off or furloughed employees to have them bear in mind. And then additionally, they've removed the 10% penalty on early withdrawals from retirement funds. That was there to previously prevent individuals from distributing from their retirement plans too early, but that 10% penalty has actually been waived. So there is access to retirement funds. And then in addition, rather than have the taxes due on those distributions in the year of distribution, you actually now are able to defer the tax due over 3 years. So a little bit of a break on the tax payments from those distributions. So I would say those are probably the 3 things that we're communicating to employers most commonly as mechanisms to help their employees, and also really, instructing them or educating them that the IRS website actually has a wealth of information in the form of, white papers and FAQs that, we would suggest any furloughed or laid off employees review or visit to kind of stay up to date on developments that may be out there for them.
Sure. Absolutely. Thank you. We all want to take good care of our employees, and those are great provisions. Thank you. Mm-hmm. So, Rebecca and JJ, a lot of the stimulus provisions apply to companies with 500 or fewer employees. What's out there for larger employers?
Yeah, that's a good question, and I think there's certainly some left to be desired for large employers. But maybe going back or echoing what JJ said earlier is, you've got a lot of references to this 500 employee count, and what's important to understand is that you may be facing different legislative guidelines and affiliation rules depending on which provision you're talking about. You may be talking about SBA rules in the context of the SBA loans and Department of Labor rules in concert with these payroll provisions. So it's really paramount importance that you're applying the correct thresholds and the correct rules to each of these provisions, because what you don't want is to not avail yourself of opportunities that you may be eligible for, or to suggest that you're not subject to some of these provisions where you might be subject to. So I would just say, first and foremost, ensure that the provision you're reviewing or assessing, that you have covered all of the affiliation rules and employee count rules for those provisions, and don't just apply some sort of blanket guidance across the table. Assuming you're maybe just, yeah, go ahead, Bill.
Yeah, just going to jump in there real quick. With the affiliation rules, is there a role for maybe the corporate attorney to play in that?
Yes, absolutely. The affiliation rules are extremely complicated. And they are actually continuing to evolve. So they've certainly left lots of ambiguity into how to interpret and who's eligible for the various provisions, who's obligated to comply with the various provisions, and if it's discretionary, how to opt out. So, obviously as an accounting firm, we want to do our best to keep our customers updated about these changes and these developments. But in some cases, corporate counsel is far better suited to help make some of these official determinations of eligibility and subjectivity. And so we're definitely recommending, a collaborative discussion about these things so that we provide the best available guidance to our customers.
Absolutely.
Thank you.
But going back maybe to the question about, really large employers. So assuming, you're way over in all respects for every provision, there's a lot of provision that you're not necessarily eligible for, but there are still some opportunities to be claimed. We've touched on all of these already, but maybe just to kind of reiterate them, the deferral of the employer portion of your payroll taxes until 2021 and 2022. Any taxpayer of any size is eligible for that, regardless of economic impact of COVID-19. You could be, going gangbusters as a result, and you're still eligible for that provision. And then eligibility to claim that employee retention credit that JJ talked about if you've got that government shut down or the gross receipts decline. There's different rules about employee count, how that's all computed depending on your size, but you're still potentially eligible to claim that credit. From my own discussions, what I'm seeing though is that maybe a lot of my larger taxpayers have been deemed essential businesses and have been allowed to remain, open and operational. And so really, they're not subject to any sort of shutdown or closure. And therefore this, retention credit's kind of off the table for them at this point in time, barring some huge decline in gross receipts, which is really unexpected for some of these companies. But it's on the table, just, may not be something necessarily that a lot of large companies will be able to monetize or take advantage of. And then certainly the income tax provisions that I talked about in the CARES Act, there's no size limitation or eligibility determination for those. It's really just based off of a taxpayer's tax profile and what provisions they're subject to. So certainly the net operating loss rules, AMT credits, qualified improvement property, and other opportunities, really it's size agnostic. So anyone's eligible to claim those benefits. Maybe lastly, what I'd say is that a lot of some of the large customers that I work with may be part of a multinational organization. And, the effects of COVID-19 have been very different among the different geographies in which some of my companies operate. So I think it's just really important to stay abreast of, the global value chain, the global supply chain and finance function, and ensure that, your transfer pricing guidance, documentation, and planning really does go through the effects on a country by country, jurisdiction by jurisdiction basis to ensure that you're, complying with your transfer pricing policies or responding to if it's worthy of response.
Sure. Thank you.
Mm-hmm.
I'll put you on the spot a little bit, both of you. If there's one final piece of advice that you would give our customers and friends, what would that be? JJ, why don't you go first?
Sure. That's a great question, Bill. I think for me, the biggest thing is that we're all experiencing new things right now. We're experiencing being family members in a different way. We're experiencing maybe children that are out of school or parents that need additional support. We're experiencing maybe working remotely or working differently than ever before. We're having to navigate, as business owners, navigate all of these different provisions and think about all of these things. And I think the biggest thing is to remember that asking for help is not a weakness, it's a strength. Bringing together a group of people as your advisors, your accountants, your attorneys, your lenders, getting everybody on the same page in the room and having those experts help you right now is the way to approach this problem. Don't feel like you have to go at this alone. The words we hear right now around isolation and distancing and things like that, we may physically be apart, but really important to reach out to those partners that you have. Obviously, Elliott Davis is here to support our customers and our partners, and just making sure that you lean into those relationships. Don't try to go at this alone. This is a team effort, and I think that we will go further together than anyone could go alone.
JJ, I think that was, well said. When I review the CARES Act and specifically, the income tax provisions within that, I read those and I think these don't seem that complicated. And maybe some of it's because I'm comparing it to tax reform of 2017, which had, a lot of complicated provisions within it. But like I said earlier, there's a lot more to it than what meets the eye. And there's a lot more, interplay between all of these provisions. And so really just ensuring that you're, involving your service providers and understanding and digesting these provisions and how they work together, and to ensure that your expectations of what you think these provisions might benefit you and how they might benefit you, are consistent with the reality of how they will affect you. So totally agree with your comment that, it's a community effort and, don't go at this alone.
Well, Rebecca and JJ, thank you. This has been fun, and perhaps we'll get you back on in the future and we'll take a deeper dive into some of the specifics as they unfold.
Bill, there could be, phase 4, so we might be back sooner than we think.
We are working on our next conversation, which will be with Ryan Lovelace, Tom Yuva, John Sutter, and Eric Smead. Their topic will include the recent SBA loans within the CARES Act, along with a number of other operational, financial, and liquidity type concerns impacting our M&D businesses due to COVID-19. So we'll be back in touch. And until then, we wish you and your team all the very best and hope that you're safe and secure. Stay safe and God bless. Thank you.
And Bill, one more thing, maybe
sure.
Just if anyone has questions as a follow-up to this webinar, please feel free to reach out to any of us by email or phone. Our contact information will be, provided as well in conjunction with the release of this. Elliott Davis has also built a landing page to host all of our COVID-19 resources, and we update that very frequently. So I would encourage, visiting that website for sort of up-to-date guidance on what's out there. And then also our manufacturing and distribution industry page on our website has a lot of industry-specific content out there. I would encourage you that if you're not already signed up for our mailing list, that you sign yourself up, and that way you'll receive emails with up-to-date guidance that's applicable to you as a manufacturer and distributor.
Thank you.
All right.
Thank you.
Thank you. Good luck.
Bye-bye.
Take care.